Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 31st of July 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Abdul-Ahad Lockhart, Currency Analyst at MUFG. This podcast is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Lee.
Hi, Abdul-Ahad.
It has been an important week for central bank policy updates, with the Fed, BoE, and BoJ all holding meetings. The dollar has lost upward momentum since the Fed's policy update. Why do you think we have seen such a turnaround?
Yeah, it's a good question. Initially, I think the market was more nervous than normal that the Fed could have hiked rates this week, but obviously that didn't happen. So I think there was some initial relief there that the Fed left rates on hold, and that definitely initially weakened the dollar. On top of that as well, I think there was an expectation going into the meeting that even if the Fed kept rates on hold, that we would see hawkish comments from Kevin Warsh in the press conference. And I think the comments on the whole were definitely kind of less hawkish than we and many people had feared, even though we did see three regional Fed presidents dissenting in vote in favor of a rate hike this week. I think overall, though, if you look at his comments, there is still a lack of guidance really over future policy. So in many ways, we're still very much kind of in the dark over how the Fed is likely to respond with their policy approach going forward. But we would kind of highlight, though, that the kind of one thing that we did see kind of emphasized on a number of occasions is that Kevin Warsh was highlighting that the recent move higher in market rates, both in nominal and real yields, was contributing to a tightening in financial conditions. And that tightening of financial conditions was helping to do some of the Fed's work. So that's kind of implying that the need for higher rates from the Fed was being kind of offset by the move higher in market rates that's already happened. So that does appear to be kind of creating a bit more leeway for the Fed to keep rates on hold in the near term. And like you say, gives them more time to assess how inflation risks evolve over the summer. Obviously, we will have a number of key economic data releases over the coming months. And then obviously the Fed will be watching, like everyone else, the latest developments in the Middle East before deciding whether to hike rates in September at the next policy meeting. But yeah, definitely going into the meeting, the market was almost fully pricing in a hike for September, but the market's obviously less convinced now that they'll definitely hike rates in September. And the market, I think, has generally seen this kind of, I guess, the lack of strong signal for the Fed to hike at one of the upcoming meetings has been viewed as definitely less hawkish. And some market participants are more fearful now that the Fed could fall behind the curve in terms of tightening policy to address those upside inflation risks. So we have seen the long end of the US curve has moved higher to better reflect those inflation risks, with the Fed being kind of inactive and not tightening policy enough. So that has resulted in the US yield curve steepening quite sharply in recent days. And normally when we look at how the dollar performs, we do tend to see that it does weaken when we see a steepening of the US yield curve. So I think those developments definitely playing into a weaker dollar since the Fed meeting. And we think as well going forward in the next couple of months, there probably is now like a higher hurdle for the dollar to strengthen further over the summer. I think the US rate market will be more cautious over pricing in additional Fed rate hikes going forward.
Thanks, Lee. So the correction lower for the dollar has been most evident against the yen. We have seen dollar yen drop from close to 164 to low of 158 at the time of this week, at the end of this week. Why has the dollar yen fallen so sharply?
Yeah, it definitely looked like Japan has intervened to support the yen after the Fed policy meeting and also ahead of the BoJ's policy meeting that happened earlier today. We can see in the latest current account balance data released from the BoJ today that it does look like they intervened, totaling around 8.5 trillion yen. Like obviously that is not a fully accurate figure, but it does suggest that very strongly that they did intervene again in the market this year. If we look back at the last time when Japan intervened, back in late April, early May, they purchased around 11.7 trillion of yen. So it looks like the latest bout of intervention was a bit smaller than we saw back earlier this year, but we'd still kind of highlight that if we look back at previous bouts of intervention, they don't tend to intervene just once. That there usually is a number of occasions when they intervene. So this may not be the last of the intervention that we see. We still think there's a high risk that we could see further intervention in the week ahead. One of the kind of key differences, though, that we would highlight compared to the last bout of intervention is that this time around, it's clear that Japan did not send kind of a clear warning or signal to market participants that they were considering intervening imminently. And that has, I think, caught the market more by surprise this time. So I think that definitely suggests a change in strategy from Japan regarding how they conduct intervention. But if we look at the scale of the move lower in dollar yen, that is similar to what we have seen during previous periods of intervention. Dollar yen tends to fall by around 3% on the day of intervention. And I say as well, if we look at also intervention also appears to have been backed again by the US authorities. There were reports overnight that the New York Fed again carried out a rate check, and we also had some supportive comments from US Treasury Secretary Scott Bessent, who stated that he believes the yen's highly undervalued and that excessive volatility is undesirable. One interesting kind of aspect, which also is different to the last bout of intervention, is that this time around, there also has been reports in the media suggesting that Korea may have also intervened alongside Japan to sell dollars. Like this joint intervention hasn't been confirmed, but definitely if that was to be confirmed, that could be a more powerful form of intervention. It would be the first time that we've seen Japan and Korea intervening alongside each other. So from a FX market perspective, that could be something which proves more effective. However, we'd still stress, though, that if you look back at previous bouts of intervention earlier this year and back in 2024, the stronger yen that we saw following intervention, that never was sustained. And we saw that most of the yen strength then tended to reverse over the following month. It's only really, I think, if you get a shift in kind of fundamental drivers, such as if we saw the conflict in the Middle East ending, the Fed leaving rates on hold through the rest of this year, and the BoJ potentially speeding up the pace of rate hikes. I think those are potential kind of fundamental triggers which would provide more sustained support for the yen. So from that perspective, it's also interesting that we also had the BoJ meeting as well this morning. And at that meeting, we definitely saw kind of clearer evidence there that the BoJ is definitely striking a more hawkish tone. Governor Ueda in the press conference was pretty clear that he saw a greater upside risk to their price outlook and added in that AI-related demand and the recent weakness that we've seen in the yen. Those are two kind of factors which are kind of intensifying the upside risks to inflation in Japan. He even went kind of further than that as well and kind of signaling quite clearly that they're preparing to hold kind of careful discussions at the next policy meeting with the risk of inflation overshooting their target more than they had in the past had considered. So I think to us that sends quite a strong signal that the BoJ is planning to speed up the pace of rate hikes, potentially raising rates at either the next meeting in September or by October, which is kind of consistent with our own forecasts. And I think if they did follow through and deliver an earlier rate hike, I think that would be something which would then offer more support for the yen on top of the kind of temporary support from intervention that we've seen. So I think that definitely is an interesting development in terms of what's happening in Japan. I think the final kind of central bank this week, which we've also had an update from, was the Bank of England. Although the impact, I think, from the pound was kind of more modest than we've seen in terms of the impact for the dollar and the yen this week. I know, Abdul-Ahad, you've been kind of looking into changes in Bank of England communication this week. It'd be interesting to hear your main takeaways.
Yeah, thanks, Lee. So as many of our listeners know, the Bank of England delivered a slightly more hawkish outcome than market participants had anticipated, voting 6-3 to leave policy rate unchanged at 3.75%. So the wider than expected vote split reflected growing concern among MPC members about inflation risks, particularly following recent increases in energy prices and heightened geopolitical tensions. So with that decision now behind us, attention shifts from the vote itself to what the newly published MPC member contributions and Governor Bailey's press conference Q&A. The member contributions point to a clearly hawkish hold stance, while policymakers acknowledged softer growth and gradually improving inflation backdrop. The dominant themes remain inflation persistence, second-round effects, and risks associated with higher energy prices and geopolitical uncertainty. Looking across the committee, divisions remain apparent. Catherine Mann, Hugh Pill, and Megan Green expressed some of the strongest concerns about upside inflation risks, with the remarks firmly focused on the need to maintain a restrictive policy stance. At the other end of the spectrum, Swati Dengra Alan Taylor remained the most dovish voices, placing greater emphasis on slowing economic momentum and easing price pressures. The most notable change came from Catherine Mann. Her comments highlighted geopolitical risks, tensions in the Middle East, and energy price volatility as a potential source of renewed inflation pressures, marking a clear shift back towards a hawkish position. However, the story did not end with a written statement. One of the most interesting findings from our analysis was that the difference between the member contributions and the subsequent press conference. The written contributions carried a relatively firm and cautious tone on inflation, whereas Governor Bailey's press conference struck a more balanced note. Although he acknowledged the risks from energy prices and inflation persistence, he also sought to push back against the idea that the bank was moving closer to raising rates. So in the conference, he actually stated, "Please do not leave the room thinking that the Bank of England is edging close to a hike." The written contributions highlighted genuine concern about inflation risks, but the press conference clarified that policymakers are not yet prepared to translate those concerns into aggressive policy outlook. The key takeaways in that is that the MPC remains cautious about inflation and continues to favor a restrictive policy stance. However, there is a little evidence that policymakers are signaling tightening. For the pound, communication remains broadly supportive, but Bailey's explicit efforts to dampen rate high expectations suggest limited scope for markets to materially reprice the policy outlook in a more hawkish direction over the near term.
Great. Good to hear your thoughts, Abdul-Ahad. And I hope everyone has enjoyed listening to today's podcast. And have a good week ahead.
Thank you for listening to this episode of the MUFG Global Markets Podcast. For more information, please contact your MUFG sales representative. If you'd like to keep up with our latest thinking, please subscribe to the series for upcoming episodes. We look forward to welcoming you back next week for fresh insights from our global markets research team.